So the next session is going to be fixed income allocations, and Soami Kohli, fixed income portfolio manager, investment officer at MFS Investment Management, will be coming up here to talk to us. I hope I didn't brutalize your name.
Good afternoon, everyone. I feel like I have the second worst time slot to speak at lunchtime while everyone's hungry. The next speaker probably has the worst one because it's another half hour after lunch. And I seem to be I seem to be placed a lot of times either at speaking at lunch or speaking before cocktails. And I finally asked someone in our office, they're like, why do I keep getting stuck with that? And they're like, well, it's bonds. Bonds are an interesting topic. People think bonds are sexy. So, if you expect sexy in the next 20 minutes, you're going to be disappointed. That's the first thing. Second thing, I'm told, like, well, you'll make it interesting, and everyone wants to talk about like this topic. And I'm like, well, I'm a fixed income portfolio manager who started off his career as an actuary. I'm hoping to get two sentences next to each other without bumbling it up. So hopefully I can make it somewhat entertaining, but we'll see. But I do promise I will get us back on time, even though the time's not running. Most of my presentations, when I'm doing them, are market-based. They're based on the outlook of what's going on in the market, what do I think Bank of Canada is going to do, what asset mix policy should be tactically right now. This presentation has nothing about that. And so if there are questions about what's going on in the market, and obviously what's going on with tariffs, because it's a big news item every 15 minutes. Apparently, the last thing I saw is that Mexico will have no tariffs, but we still may have tariffs, which blows my mind. We can talk about it at the end. But I bought something recently that kind of summarizes my whole view on this tariffs thing. And I'm going to just, if you indulge me, I'm going to put it on. And this is what I really feel about the whole topic at the end of the day. That Canada is not for sale. Someone who's grown up in Canada, born in Canada, worked in Canada my whole life, I am so impressed of how united we've come across the country to fight what's going on against the economy. It is actually surprising to me that would happen. So if you want to talk about that later on, we can ask questions. What I'm going to talk about today is the role of bonds and why is it finally a good time to invest in bonds after about 10 years of not investing in bonds. And I'm a bond traditionalist. So when I say that, what I mean is there's two things that you want from your bond fund. First thing is you want to earn a decent amount of income. The yield you get on your portfolio is going to be, on a high quality bond portfolio, is what you're going to earn in the next 5 years. And I'll show you some data on that as well. The second thing is you want your bond portfolio to provide some sort of protection in an economic slowdown. In the previous 10 years, up until 2023, you couldn't really get a bond portfolio to do both. Because for a long time, the yield that you got on your bond portfolio was actually less than the yield you got in equities. So if I'm telling you your return is going to be your yield, and you're getting a higher yield than equities, back then you should have just bought equities all day long and just deal with the volatility that you've had. Unless you have some regulations, unless there's some funds like there's some funds like pension funds that have mark-to-market issues, but in general, you shouldn't be buying bonds if you can earn a higher yield in dividends and you can withstand the volatility. It is not the case today anymore. So, here we go. So here are two bond funds. So one is going back in time to 2021, and one is looking at as of this end of last year. And we're saying if you had to construct a bond fund to earn a 4.5% return, what would you have had to do in the past and what do you have to do now? And in the past, you essentially had to have most of your bonds in high yield. and in emerging markets. Emerging markets and high-yield bonds are a very good fixed income class, but they do not provide you the protection in an economic downturn. So I go back to the two things I think your bond fund should do is one, provide yield. The second is provide you the protection in a downturn. High yield will behave like an equity fund. It'll more likely to have negative years than a high quality fund. You fast forward to today, finally, you can actually have a high quality bond fund consisting of investment grade companies, right? So the best of the best companies that are coming in Canada or in the US that are coming to the bond market to borrow money. You can also buy government bonds, and you can have some small allocation to high yield. And you want that. And then the reason why you want that, I think yesterday Peter was talking about a free lunch. Diversification is the only free lunch. In the bond world, there's actually still two kind of free lunches for now, probably over time, maybe over the road, in which you can actually close your eyes and buy something and almost get a very good return, which involves a little bit in the high yield market, and I'll talk about that after. So today, finally, you can get your return and you can get your protection. For those who can read that, essentially what this is saying is showing returns over the last calendar year, 10 calendar years, Canadian government bonds, Canadian investment grade corporates, US high yield, and emerging market. And what I'm trying to emphasize here, the red numbers are where we've had negative returns. So we did have negative returns in Canadian government bonds and investment grade corporates because that was a function of undoing what was done during COVID. But high yield in emerging markets, while they are technically fixed income, they are more equity-like. And you can see they're more likely to have negative years returns. They are not going to provide you the protection that you need. So we can finally do it now, which is great. So you can actually probably de-risk your portfolio and still get a higher return or a similar return and get that second benefit. And I said at the beginning, in terms of predictions of return, your starting yield is your best predictor of return in a high-quality bond fund. Right now, I'm just showing you index data. So this is for the Canadian index in total. Doesn't include any alpha on top of that. And the way you read this chart is the vertical axis is your starting yield in which you bought your bonds. And the horizontal axis is what you will earn annually over the next 5 years. And you can see outside, let's see if I can get this to work. Yeah, can't get the air. Anyway, outside those first dots on the left, can't get that to work, which are actually post-COVID months. It's a pretty vertical, a line that's almost at 45 degrees. In other words, as your yield goes up, your future return goes up almost by the same amount. And the light blue dots represent periods of time when the Bank of Canada was cutting rates, and the dark blue dots are those periods of time when the Bank of Canada was rising rates. Obviously, over the last, this data is probably 30, 40 years old, we've been cutting rates a lot more than we've been hiking rates in that period of time, so that's why there's a lot of light blue dots. So if you look at the index right now, having a yield around 3.5, historically, that meant you're going to earn about 5%. That's not including, if you buy a bond fund, you're probably out yielding the benchmark by 50 or 100 basis points, so you're going to earn more. So when you are looking at your bond fund and you're looking at planning going forward, if you have a high quality bond fund, look at your starting yield that your manager has. It's going to be your best prediction of returns. There are going to be some years it's going to be 8%, some years it's going to be 4%, but over those 5-year period of time, that's what you are going to earn. Now, I don't know how many in this room have done this, but I think a lot of people have done this personally, is that there's been a shift to cash, right? I can get a pretty good return on a money market. I can get a pretty good return on GICs. And this is showing different time periods, but essentially what this is saying is, over time, bonds always outperform cash. Where cash outperforms bonds is at the very beginning of a rate hiking schedule by the Bank of Canada, And once the Bank of Canada either gets to its second last hike or its last hike, bonds start outperforming cash. So I don't know if it's as relevant because I'm not sure how many people may have moved to cash, or there's obviously the short-term funds maybe have gone lower in duration. But to the extent that if the argument is, oh, I should go to cash, I can get a similar yield maybe right now. True, but what you're not getting is that second part, which is the protection. And frankly, over time, you're not going to get the same yield. It just doesn't work that way. So cash may have a relative attractiveness right now, but it's not providing you that protection if you think we are going to go into a recession. And, when the Bank of Canada, so bonds providing you protection. So I'm going to be clear about this, because I think in 2021-22, there was a lot of debate. Bonds provide protection to portfolios when there's a slowdown in the economy. Bonds may not provide protection to a portfolio because of an equity sell-off and there's no recession. For example, in 2023, was it? I always get the years confused now. The beginning of the year, we had about a 20% drop in equities. And that was when everyone's like, oh, we're going to recession for sure. We're having a recession. 2024, we're having a recession. We never had a recession. Because the bonds will not provide you a protection in that case. That was actually a buying opportunity for equities, frankly, with hindsight now. Bonds provide you protection when you have an economic slowdown because when you have an economic slowdown, central banks step in and cut rates. And when they cut rates, duration or sensitivity to interest rate is your friend. And that's why right now the combination of higher yields plus also tactically what's going on right now with all the uncertainty and with the Bank of Canada have been cutting rates, bonds have been very attractive. And they expect to have very attractive returns. I'm going to show you a chart later on outlining some different scenarios in terms of where returns could be. So the free lunch. So I'm going to talk about two things that you may not be using in your bond portfolio, or maybe you are, that represent a free lunch in the market, in the bond market. And in bond managers, most bond managers, they should know this, that it exists, and they should be exploiting it as well. So what you have here are average yields for different ratings of bonds. So AA being the safest bonds, companies that kind of go to the lend, till BBB. That category is called investment grade. And then you have on the other side of the line, BBs to CCCs, which are the high yield market, which are still good companies, but lower in quality. Maybe more debt, maybe their business is not as stable, et cetera. Typically what's happened, and you may see this in your own bond portfolio, is that when bond managers are hired, they're either hired to be, you're an investment grade manager. So you must only buy bonds that are BBB and higher. Or you're hired as an high yield manager. You must only buy BB and below. And so what happens, unless you have a deep credit research team, and you're a manager that's been told only buy BBB or higher, you get scared to buy a BBB bond. You're scared that that company is going to get downgraded to high yield, and you have to come to the client and say, sorry, we bought this bond, we made a mistake, it got downgraded. So there's a natural tendency to move away from the BBB bonds. On the high yield side, high yield managers look at the yield that you can earn on a BB bond, and they're like, that is just not juicy enough. Like that is basically me buying a GIC in the high yield world. So I want to avoid that because I can't get the returns I need if I buy that. And what it's showing you on this graph is where the blue boxes are bigger. So the overall box represents the average return you should get on that rating category. The gray box represents the average loss that you should expect over that time. And your blue is what you're going to get in return. So you want to invest in the boxes that have the biggest blue boxes. And that's why there's funds that are out there that are called core plus funds that will come in and dabble in to buy the high yield. If you did nothing, like if you were a manager and you didn't have a research team, you did nothing, all you should do all day long is overweight triple Bs and double Bs, because over time they're going to outperform because of this inefficiency that currently exists in the market. And to the extent that you can tap over and tap back in and out of that market, it's a great place. So your bond funds today, if they're more traditional and they're just the investment grade up, it's something worth looking into expanding into your bond portfolios to add some of the high yield, whether it's a core plus or something similar. The other free lunch is looking at the U.S. market. So what we have here on the left is a slide of corporate spreads. Blue is Canada, green is the U.S. And what you can see is they essentially mirror each other over time. Our economies are so interrelated. Companies borrow money in both geographies. So over time, they should be like that. But if I were to blow up certain periods of time, what you'll see is when there's stress in the world, the U.S. corporate bond market underperforms Canada. And so to the extent that you allow your bond manager to step in and out of the U.S. market can really drive a lot of extra returns in the bond portfolio. So for example, the way again, as this goes up, bonds will get cheaper, that big spike at COVID, they look like Canada and the U.S. is the same, but it really isn't. The U.S. market sold off corporate bonds in the U.S. or spreads in the U.S. were about 50% cheaper, 40% cheaper than they were in Canada. And so be able to tap in there. And I blew up this part on the right. It's a more recent time frame. And if you look at the very beginning, you see the green line shoots up. So this relationship still exists. This green line shoots up. So Canada was cheaper than the U.S., Canada was cheaper than the U.S., and all of a sudden the green line shoots up. That's when we had the Silicon Valley Bank bankruptcy and the regional bank issue. Again, what happened? Stress in the world, U.S. bond market, because it is the most liquid, probably has the most realistic prices, started underperforming. We, at that point, were like, oh, okay, now it's time to get ready to buy U.S. bonds. Central banks kind of contained it, and it went away. So to the extent, again, if you have a more traditional bond fund that maybe doesn't allow you to go outside Canada, allowing your manager to kind of go outside Canada almost allows you to take advantage of these points in time when you have stress in the market that they can jump in and jump out to buy it. So what will bonds return going forward now? So universe data is not any fund data. This is hypothetical under different scenarios. So the way to read this is the vertical axis, as you go up, means the Bank of Canada is tightening or raising interest rates. As you go down, the Bank of Canada is cutting interest rates. And then the horizontal axis is as you go to the right, corporate bonds are going down in value. And as you go to the left, corporate bonds are going up in value. And currently the index we're in the middle, so 3.54%. So again, what I said before, if you bought the index at 3.54%, you should probably expect to get about a 4% return over the next 5 years. Given what's going on, now everything's changing every 10 minutes, so it's hard to say what's going on. But if we were under the impression that we are actually going to have tariffs, and they're going to stay in a long point of time, the Bank of Canada will cut rates. That's my opinion. And there's some views that are different on that, but that's my opinion. They're going to cut rates. And that means what you should expect to see, and corporate bonds probably get cheaper a bit. In that environment, fixed income should probably be giving you returns of between 7 and 15%. And why such a big range is I just don't know how bad the tariffs are going to be, and I don't know how long the tariffs are going to be. So is the Bank of Canada going to cut rates 1%, or are they going to cut rates 2%? But they're going to cut rates. And so even tactically, like in the next 12 months as we go through this, or next 4 years, who knows, it's a very good time for fixed income. There is a scenario that's probably separate from this presentation, I feel like I have to mention, that could be troubling for the economy. And that is, we could be setting ourselves up for a post-COVID scenario again. And what I mean by that is, so the Bank of Canada steps in, they're cutting rates and they're cutting rates. We still don't even know what the fiscal response will be from the government. So if the fiscal response is COVID-like, then maybe the Bank of Canada doesn't have to cut rates. But if they cut rates before, because we don't have a government right now, so like it's going to take time for that fiscal response to come in place on the federal level, that you could have the Bank of Canada cutting rates, you can have a fiscal policy come in, and then you can have Trump remove tariffs again, and that could set up a big bout of inflation. I mean, that's a 2027, 2028. It doesn't move that fast, but that is a big concern, and I think it's on probably in the minds of the central banks too, that that's why some people are saying they should cut by 50 basis points next week. I don't think they will, because they're worried about that scenario down the line. So, in conclusion, good time for investment bonds, finally has the characteristics that we haven't had for the last decade. If your bond portfolios are more traditional, there are some free lunches out there that you can take to get some additional returns by allowing your manager to expand. And going forward for the next year, I imagine bond returns will actually be quite good given the macro environment. I'm going to pause there. Any questions? By the way, I can't believe you guys didn't clap about my hat. I was expecting a clap on the hat. I get people high-fiving me when I'm walking down the street with the hat, and I'm almost like, I feel so proud, I want to wear it everywhere. Yes?
That was literally my first question, was where can we buy that hat?
Not on Amazon.
Thank you.
Shopify, online. I Googled it, and I bought it. Now, it did take a little while to get here. It wasn't as fast as Amazon.
Thank you.
Any questions? Yes, in the back. Thank you.
I'm sorry, my question is, why didn't you order one for everybody here?
Right? Actually, my wife said the same. I said I ordered a toque and I ordered a hat. And she was like, and what about me? And I was like, I just didn't, it wasn't in my mind at the time. So. Okay, well, if that's it, hopefully you get to lunch soon. Thank you, everyone.